So everyone knows what the stock market is and the general concept of buy low, sell high, because it's been made popular in movies, TV, radio. So let's talk about some small differences between the currency exchange market and the stock market that make them more preferable and attractive to a certain type of investor. So the first difference is leverage, meaning borrowed money. In the stock market, you can't really borrow money. If you have $100 to trade, you can only buy $100 worth of stock. Where with the currency market, you can use up to 50 times leverage, meaning that you can make a lot more with a lot less money when you're starting off trading. The second difference is the hours. The stock market is open from 9:30 a.m. to 4 p.m. Eastern time. So if you have a 9 to 5 job, it makes it a little bit harder to trade unless you're already sitting at a computer, and you won't get in trouble for looking at the stocks or analyzing while you're at work. The currency market, on the other hand, is open 24 hours a day from Sunday night all the way to Friday night. So you work a 9 to 5 job, it makes it a little more accessible because you can trade before or after work and still have an opportunity to make money and replace your income without having to give up your job as a whole. The third difference is something called the pattern day trader rule, and it applies to the stock market but not the currency exchange market. Basically what it states is that if you have less than $25,000 in your trading account, you can only trade about 4 times per week, meaning that if you want to open 3 different positions, your third one might actually not even be closed no matter how much money you're losing at the end of the day because you've already traded your certain amount of times. With the currency market, you can actually trade as much as you want to without any sort of penalty. So you can trade 100 times a day if you want to, and you'll never be flagged with any sort of pattern day trader rule. The fourth difference is volatility. Now, the currency exchange market is relatively more volatile than the stock market. Now, that's not across the board on every single stock. It's less volatile than the currency exchange market. But as a whole, the stock market is more stable and it's more of a long-term buy and hold type of positioning. So the reason for that is because all of these stocks are actual individual companies whose obvious best interest is to keep growing and keep their stock increasing. So when you buy a certain amount of shares, you're buying a certain portion of that company. So not only do they want your shares to increase, they want them as a whole, as a company, to increase, meaning that everyone wins in the end. So basically what volatility means in the end is that if you're more of a long-term buy and hold trader that wants to hold for years and see a trend play out over months and years, then the stock market is going to be more attractive because the currency exchange market, the trends tend to last from a couple days to a couple of weeks as opposed to a couple of years as in the stock market. So the fifth and last difference that I want to go over between the stock market and the currency exchange market is the type of analysis that it takes to find a good trade in the stock market versus the currency exchange market. Now, the stock market tends to rely heavily on technical and fundamental analysis, meaning that not only is it important what the actual price of the stock has been doing in recent history, but it's also important what the company itself has been doing within the walls of the company within recent history. Meaning that you can see what it's been releasing as far as financial reports, but what new products is it coming out with? What is the CEO saying in recent interviews and talks that he's been in or she's been in? What is it doing on the news? How are people reacting to new products being released? You have to look at both the stock price as well as what's going on news-wise with that specific company. So the currency exchange market, on the other hand, tends to rely heavily on technical analysis. Since there's not one specific entity that the trade is actually attached to, it's 2 entire economies pitted against each other in the currency exchange market. So the only thing that most traders have to trade on is technical analysis. Now this actually is a self-fulfilling prophecy because with technical analysis being the only thing that you can really rely on in the currency exchange market, it makes technical analysis a lot more effective and potent in the currency exchange market than in the stock market. So fundamental and technical with the stock market and heavily technical with the currency exchange market. So once again, real quick, the differences between the stock market and the currency exchange market is leverage. You can borrow a lot more with the currency market than you can with the stock market. Hours, the 9:30 to 4 o'clock hours of the stock market versus the 24 hours a day, 5 days per week of the currency exchange market. Number 3, the pattern day trader rule. You can trade up to 4 times per week, where the currency exchange market, you can trade as much as you want. Number 4, volatility. The stock market is a little less volatile than the currency market, meaning that trades last longer, years, months, however long you want to hold a part of that company, where with the currency exchange market, trades typically tend to last from a day to a couple of weeks. And number 5, analysis. Stocks rely heavily on fundamental analysis, with technical analysis being considered, where the currency exchange market relies heavily on technical analysis. So those are the main differences between the stock market and the currency exchange market. You could take the pros and the cons yourself and weigh out which one seems more attractive to you.